Well, folks, do we have some things to get into here today, okay? First up, quit being a pew-pew, okay? We'll discuss that in this video. I'll explain exactly what I'm talking about there in this video right off the bat, okay? Then we need to get into the CPI numbers that came out here today, as well as Jerome Powell. Obviously, Fed chair came out and spoke today. There was something very important he said that I want to take you through if you're thinking about when the Fed's going to cut rates, okay? Fourth thing we're going to get into is Nvidia rolling again here today. Another great day. Is Nvidia about to hit 150 plus here very soon? We'll discuss that. Cheesecake Factory stock is absolutely rolling. It's over 40 bucks now. It's 50 coming very soon in regards to that one, so we'll get into that particular stock in this video. And then the sixth thing is the moment I'm going to get more skeptical and bearish on this market. A lot of people have really tried to jump the gun over the last couple of years, and I'll explain when I get a lot more concerned about, let's call it, the future year or two in regards to market. I'll explain exactly that in detail in today's video, okay? I don't want you to hit today's like button like a little fairy, okay? Today we're Hulk smashing and Hulk smashing only. If you break your device, you break your device. I don't really flip and flapjack and care. It just needs to be done, baby, okay? So, I was speaking about Apple yesterday. Some people got very butthurt. Very butthurt. Oh, Jeremy, you're being mean to Apple. You're supposed to only talk about the positives. Don't talk about the negatives in regards to any stocks, and especially a stock I own. And a lot of people are very butthurt, and they're going to cancel me for speaking about the ways Apple's mismanaged their business over the past few years, right? At the end of the day, if you're a stock in the market, I'm going to criticize you when you make bad decisions, okay? And Apple's made plenty of bad decisions over the past few years, and I've been very critical of them, right? And so I do that for all my stocks that I hold. I've been critical of Elon Musk several times. I've been critical of Tesla. I've been critical of I've been critical of myself even in the past several times on the channel when I've made big mistakes and said, I need to do better. I screwed up. Like, here's what I did. Here's what I need to get back to. Like, I have no problem with that, right? But other people have a lot of problem with that, okay? In regards to Apple, here's what you're dealing with. You're dealing with a mismanaged company. This company, on a 2-year stack basis, the revenues went down. Look at March 2022, $97 billion of revenue, and you're doing $90 billion in this latest quarter. Now, the excuse will be, well, you know, consumer inflation. Baloney. Look at all their peers, right? All the other trillion-dollar boys club, right? All those companies have seen their revenues go up substantially over the last couple of years. Apple's the one that's gone down substantially by roughly $7 billion. You flip my flapjacks. Gross profit has also gone down on a 2-year basis for this company. That's a mismanaged company. But it gets far worse. Their first product they've ever released, their first major hardware product they've ever released without Steve Jobs and without Johnny Ive, flopped. It's a flop. Could you ever imagine Steve Jobs coming out and announcing a flop project? Like, come on, where they got to cut production? Apple had to cut production because it's selling so poorly. There's such low level of demand interest in regards to their new hardware project. And this is where I wish, like, this is a problem with social media at times. The news cycle moves so fast that no one has any time to really analyze anything. If this was the old days before social media and before everything moves so fast and people get over stuff and it's the next TikTok video and the next Instagram video, there would have been so much debate and talk about how Apple's first product without Johnny Ives and without Steve Jobs is a complete flop. But since the news cycle moves so fast, no one talks about it, right? Oh, and if anybody talks about Apple, it's like, wow, did you see that big share buyback? I mean, Tim Cook, he's just taking all the profits that are Steve Jobs' profits that he built his business with and using those profits to go buy back shares. That's not running a business on a high level, right? And even with all those buybacks, right? And even with that great stock performance the past 2 days, this is the bum stock of big tech. If you compare them versus all their peers, the other trillion-dollar plus companies, they're the bum company. This is since all these stocks bottomed back in the fourth quarter of 2022. Apple's at a 55% gain, while the Nasdaq's at 77%. It's getting wrecked by the Nasdaq. Like this was something that shouldn't even been thought as possible before. And this is after the crazy performance over the past 2 trading days, right? Microsoft's at a 94% gain since that time. Google McDougal's at 102% gain over that time. Amazon is at 113%. Meta's at nearly 400% gain over that time. And Nvidia's at nearly 800% gain over that time. And this is a company with unlimited amount of resources. They've spent like $700 billion on share buybacks in the past 10 plus years. So what do we have to show for it? An underperforming stock, an underperforming business that the financials have gotten far worse over the last couple of years. In their first major product they launched since Johnny Ive and Steve Jobs, like that doesn't have either of their inputs, it's a flop. It's a flop, man. That's embarrassing. And so at the end of the day, when I'm critical of Apple or I'm critical of any stock, it's because I've been doing this a damn long time. And I made a lot of money off Apple stock back in the day. I made a lot of money off of semiconductor companies I owned that did huge business with Apple. I understand that business on the highest level possible, all the way down to exactly how the phones actually work. And when I'm here to tell you a company's underperforming, it's because they're underperforming. And so don't think of it as hate or anything like that. It's just calling it out how I see it. And you can't debate the numbers. The numbers are pathetic. And so that's it's not like I'm doing it just to hate on these guys. I'm doing it because there's reasons that I'm seeing a company completely mismanaged here, and a lot of people aren't waking up to that. But I will say, enough people are waking up to it, right? Now, a few things here. First up, okay, and this is regards to don't be a pew-pew, okay? First thing, you need to thank people when they point out weaknesses of your stocks, whether that's in actual weakness or not. SWOT analysis is one of the most important things you can ever do when analyzing a company, right? Looking at the strengths, weaknesses, the opportunities, and the threats for a particular company. So when somebody's pointing out weaknesses, thank them for doing that, because that's the most valuable thing you could ever have, right? Remember the second thing here. Stocks are about what? It's about risk reward. If you go to say, I'm going to put $50,000 into a stock, $20,000, $100,000, $1 million, $20 million, whatever amount it is, it's about what are the chances I'm going to lose 50% plus in the stock over the coming years versus what are the chances I'm going to double up my money over the next many years, right? That's what it comes down to. It's the risk versus a reward. So whenever somebody's pointing out the problems with the company, thank them for that. They might give you some details there and some insight that you didn't really consider. And you need to consider those things, right? And the third thing is confidence, right? So many people don't want to hear anything bearish about their stock or anything like that. You're going to build a lot of confidence in your decision making by looking through the window. A lot of people don't even want to look through the window. They're scared of it. Oh, I can't even look through the window. Look through the window. You'll build more confidence in your position. If you walk away hearing a bearish argument, somebody destroy a stock that you own, and you walk away from that feeling great and feeling that, those aren't really issues I see for this company, great. You just built even more confidence because you were willing to hear the other side, right? The problem is when people aren't willing to hear the other side. You've got to look at all those. Whenever I look at any stock I'm buying into, I look at what are the competitors doing? What are the chances this company, maybe the bears are right in regards to this, right? It doesn't matter what stock, it could be PayPal. I think about, Apple Pay. I think about Cash App. I think about all these different dynamics. Okay, here's the risk, right? If it's a Nike, I think about all the different risk factors. Did that with Meta over the years, Tesla, all these stocks. You got to be willing to at least hear it, okay? That will build you stronger. That will build more confidence in yourself and your decision making. If you're not willing to look through the window, you're lost in this game, okay? So very, very important, don't be a pew-pew, okay? Yeah, you're part of the problem if you're a pew-pew. Now, next thing up here, let's talk about CPI numbers. Let's talk about Jay Powell, very important thing he said here that we got to talk about, and then we'll get into Nvidia, cake, and the moment I'm going to get much more skeptical and bearish on the market, right? So first off, if we look at the number here, 3.3% CPI came out at, right? And here's another way to look at that, right? The Fed wants CPI at 2.0, right? 2. So 2 is seen as perfect in the Federal Reserve's eyes, right? So if you're at 3.3, you could look at that. And another way to look at it is CPI is 65% too high, right? Because you say, well, 2% is perfect. If we're at 3%, that's 50% too high, right? 4% is 100% too high. You could easily look at it that way instead of, because sometimes it sounds like just such a small number, like, oh, it's only 1.3 percentage points off of where the Fed wants it. In reality, it's a lot further away than you think, right? And so that's very important. Everybody understands that we're still a long dang way from where the Fed actually wants inflation rates to be, right? Now, when you look more in depth at the numbers, there's a lot of troubling things here. First off, okay, is that number reality? If you go grocery shopping on a weekly basis, let me know if you believe that food at the grocery store has only gone up 1% in the past year. Please, in the comments section, let me know. because I don't go grocery shopping enough to really be able to feel like, oh yeah, I think prices are, it's basically saying prices are flat. I mean, 1% is like nothing. So it's basically saying, if I go to the grocery store, I'm spending the same amount this year that I spent last year for the same exact things, right? What do you guys think? Let me know in the comment section, because I don't go to the grocery store enough to really have an opinion like that, to be honest. So if you do your grocery shopping, you pay attention to that, please let me know in the comment section if you think that number is accurate of 1%, right? Because I feel like some people aren't going to really believe that number. Next up here, electricity. Obviously, we know one of the biggest bills folks face is electricity, and electricity rates are considerably higher, about 6% roughly higher than they were at this time last year. No bueno, because wages have not gone up 6% in the past year, right? If you look at other major expenses here, we got some problems, right? Motor vehicle insurance, 20% plus up on a year-over-year basis. That's a major expense for people, right? Motor vehicle repair up 9.5%. Whew, brutal number, right? Something goes wrong with your car, it's very costly to go get that thing fixed, right? Outpatient hospital services up roughly 8% year-over-year. No bueno, no bueno. Veterinary services, something goes wrong with your pet, you got to take them into the vet, right? 7.6% up year over year. Brutal. These are all big expenditures for folks, right? And then rent of primary residence is up over 5% year over year. Yeah, I mean, shoot. They call us the nation of renters, right? That's no bueno. So when I look at the inflation numbers, we still got a lot of problems. This game is not over. Are we doing a lot better than maybe a couple years ago? Sure. But that's not saying the most, right? Because that was also the highest inflationary environment we dealt with since really the 1970s, 80s, right? So things are all progressing, but guys, this is still, we got a lot of problems. And it's not like you can point out to just one category. Sometimes people try to point out to only one thing. Like, oh, it's only auto insurance is out of hand. No, damn it. These are major expenses that are way too high. And wages are not going up that much as a general sense to really offset these, right? So I thought that's a little troubling. Now, in regards to POW, right, this is very important. The Fed obviously didn't change rates, so I think that didn't come as a surprise. But right here he says, too soon to tell if Fed policy is sufficiently restrictive. And it's big there, right? The Fed does not yet have the confidence to lower rates. Federal Reserve Chair Jerome Powell said the central bank does not have the confidence to start lowering interest rates even after May's consumer price index on Wednesday came in cooler than expected. Quote, we see today's report as progress and, as you know, building confidence, Powell said. But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time, he says. The Jeremy translation of this is maybe in 3 to 6 months we'll cut. Maybe, right? That's basically Jay Powell there. They're not ready to cut anytime soon, so if you're expecting a cut in the next month or two, not happening. Maybe in the back half of the year at some point in time, maybe Q4. It's a potential, but we've got to see that CPI number keep coming down. My opinion always from the beginning was the Fed was not going to start cutting until they got 2 consecutive months in the 2s for CPI. That's always been my opinion and stance on when the Fed actually cuts, unless there's some sort of major, recession that pops up before that happened, then they would cut because they would try to focus on employment. But outside of that scenario, I think they got to see 2 straight months of CPI in the 2s, right? And so hopefully we get there sooner rather than later in regards to getting that CPI in the 2s and out of the 3s, but we'll see. We'll see, right? Next one up here, Nvidia to 150 soon. So let's speak about Nvidia for a moment here. First off, up another 3.5% here today. The stock price momentum is unreal. Nvidia, every time it has a day where it doesn't go up, you're like, it's going back up. It's just literally every day it has one of those days where the stock goes down a couple percent or even just stays flat. You're like, it's going up. And that's exactly how I feel with in regards to Nvidia. Like if the stock goes down 1% tomorrow, I'm going to be like, the next day it's going to feel up, right? That's Nvidia. The price momentum is unreal in the short term. And remember, the weighting of Nvidia has gotten a lot bigger now. So basically, there's going to be a lot more forced money coming into Nvidia because the market cap's gotten so big and the weighting's gotten so big in the Qs in the S&P 500. So if people are putting money into the S&P 500, people are putting money into the Qs. When rebalancing comes, essentially more money has to go into Nvidia since our market cap has climbed so substantial. So that definitely helps out the stock if you're thinking about the back half of the year. Okay, so the price momentum is unreal. And here's the thing with Nvidia, right? The stock is not trading at crazy multiples still, even with this run where it seems like it goes up 3% almost every day. Here's the deal, okay? Forward P on the stock's 52. So we can call it a little over double where stocks usually trade at in the market, right? But keep in mind, the growth rates are way above double where average stocks, revenue growth is in earnings per share, right? Also keep in mind, if you look at the 52 forward P here on 1000xstocks.com and you look at the 2-year forward P at a 35, right? Keep in mind, those are taking analysts kind of together, right? And kind of averaging out what their earnings per share estimates are for the next couple of years versus where the stock price is, right? But keep in mind, what have analysts done? Analysts have been far too low for the last year and a half, or at least the last year in regards to Nvidia numbers. So there's a good probability the earnings per share estimates could end up being too low. So there's a very good probability the forward P is actually lower in reality than where we have it here, right? And the 2-year forward P is a decent probability that's too low as well, right? So that's just a little food for thought in regards to that. Then you look at the earnings per share growth. I mean, if you compare them against their other big peers, because these 3 companies are battling it out right now for the biggest market cap in the world. It's between Nvidia, Microsoft, and Apple, and they're going back and forth right now, right? And you look at these 3. Well, guess who actually has the insane growth? It's Nvidia, right? Trailing 12-month earnings per share growth, 189%, versus 14% from Microsoft and versus like 6% for Apple, right? And I'm sure Apple's really gotten their earnings per share growth from those buybacks, if anything, right? Current year expected earnings per share growth, 227% expected for Nvidia versus around 20% for Mr. Softy and around 9% for Apple. If you look at next year earnings per share growth, 40% expected for Nvidia, 16% for Mr. Softy, and around 10% for Apple. So the growth rates for Nvidia are just astronomically high, right? If you look at trailing 12-month revenue growth, triple digits, over the last trailing 12 months, right? Over 162% expected in the current year, and then next year, roughly 40% or so revenue growth expected. I mean, these numbers are crazy beast numbers. And that might even be the most insane thing. Check this out right here. Gross margin and net margin. Keep in mind, Mr. Softy is seen as like the pinnacle of companies when it comes to gross margins and net margins. Software company. I mean, usually those business models don't get any better than that when it comes to your margins. 70% plus gross margin and then net margin of 35% plus. And then Nvidia just blows it away at a 78% gross margin and net margin of 57%. And remember, Nvidia is selling actual physical items, chips, right? And all the infrastructure that goes around those chips. So it's crazy to think the margins are that insane for Nvidia when they're really actually selling physical products as well as software, right? That's unbelievable. So when you look at Nvidia from that perspective, I mean, just to be quite frank, the stock has more room to the upside in the short term. It has more room to the upside. There's no doubt about it. And so when I think about Nvidia and I think about, is this run about to end? I don't think right now, right? And so I'm thinking Nvidia could easily hit $150 to $200 in the back half of this year, right? But the thing with that is that could end up being potentially a multi-year top that the company reaches. So let's say it goes to that $150 to $200 range, especially if it pushes like 200. That could end up being a multi-year top because then essentially business cycle would still be great in 2025, but let's say there's a major slowdown in 2026 going into 2027. Well, shoot. Obviously there would be a big downfall coming in that stock because of valuation. At that point, assuming it went to $150 or $200, the valuation would have gotten very, very much more stretched at that particular time. And then Nvidia would have to deal with, potentially numbers that would be down year over year. They'd have to potentially deal with the cutting of chip prices. They would have to deal with a lot of crap, right? And so for right now, it's all blue skies ahead. But at some point, the clouds will come. Just people have tried to jump this way too fast. Remember these chip cycles. These chip cycles last 3 to 5 years. And I've said this since the beginning, right? They last 3 to 5 years. We're in year 2 of the chip cycle. Basically, next year is another guaranteed banger year for Nvidia's business model. Not for the stock. It's not a guaranteed banger year for the stock. But it's a guaranteed banger of a year for the business model, right? And then I think 2026 and 2027, that's where you start to really have questions about can Nvidia keep the momentum going at that particular time, because there's a good, decent probability they're already doing 200 billion plus in revenue at that particular time, right? So a little food for thought in regards to that. Now, me personally, obviously as an Nvidia shareholder, I'll be probably looking to get out of this one in that $4 to $5 trillion area. There's a stock or two I really like, better than Nvidia for the long term. And so I'm thinking if Nvidia makes another nice run here over the next few months and we stretch this baby to a $4 or $5 trillion company, which I think is very much a possibility, I would be likely looking to get out there. And I'm fine if I don't perfectly time the top. Like if the stock went up another 10, 20, 30% after I sold out, that's perfectly fine. I'm just thinking about it from the perspective of there are a few companies in this market that I like a lot better for the long term than Nvidia, especially if Nvidia goes to that $4 to $5 trillion area, which honestly could happen in the next few months. It's not like, for this company to gain another trillion in market cap, it could happen in 3 months. Literally. Nvidia could gain another $1 trillion of market cap within 3 months. That's all it takes. It's not like you got to wait years and years. It could gain another $1 trillion plus within 3 months. Okay? So, important in regards to that. Cheesecake Factory is over 40. Is 50 coming soon in regards to this one, okay? So, yeah, the stock started rolling. We're already up 23% on this one, not, accounting for dividends, and that's in a pretty quick amount of time. Stock up another 3% here today. I'm not happy about it. That's why I got the sad face here, because Cheesecake's a stock I'm just looking to add more and more shares of. I really don't want the stock to be rolling already, but it is. And I'll be quite honest with you guys. If this Russell really gets moving, oh my gosh, like cake's going to be $50, $60, like quick. If that Russell really gets moving, right? I mean, it wasn't even like that great of a day for the Russell. What was it, about a 1.5%? And on that 1.5%, cake's up 3%, right? So if you're talking about the Russell Wilson goes up, let's call it 10%, 15% over the next, just assume it's in the back half of the year. Let's say the Russell Wilson goes up 15% in the last 6 months of the year. I mean, Cheesecake's probably up 30, 40, 50% in that sort of environment, right? So a little food for thought in regards to that. Now, in regards to the business model of the cake, it's obviously getting a lot better. If you look at kind of on a 2-year stack here, revenue $793 million in this same quarter they just reported here recently, a couple of years ago, versus $891 in this most recent quarter. Gross profit went from $309 million to $367 for the company. If you look at operating income, went from $29 million to $42.5 million. And if you look at net income, went from $23 to $33 million, right? So the company's business model, the fundamentals are getting better and better, despite the inflation excuses and everything everybody else is using out there, right? Because everybody's using these excuses. Oh, it's inflation, it's hard, the consumer, right? Cheesecake's like, we run a restaurant business, and the cost of doing business for us has gone up substantially, but at the end of the day, we're still putting up great numbers, and so I appreciate that. But it's not just that in regards to cake and why this one has a lot of room for the upside here. Here's the deal, okay? Forward P on the stock's in the 12-ish range. 2-year forward P is in the 11-ish range. This stock, given what I believe is the growth rates for this company, given that they got 2 banger concepts with ridiculous expansion opportunity over the next 10 to 15 years in North Italia and Flower Child, those are like guaranteed just banger concepts that they're going to be able to have hundreds of locations around the United States very soon here, right? I think this stock should trade at more of a P ratio in the 20 range, which would be roughly in line with the market. If it trades at around a forward P of 20, that's roughly in line with the market. That's where the stock should be trading at, not these sorts of joke prices. So just on valuation, we can call it upside here. And the stock has so much room. It's like for this stock to all of a sudden be $50, $60, even $70 is not crazy at all, just on valuation. Now, on top of that, the earnings per share growth here is expected to be very, very nice. Under 20%, but it's still a very nice double-digit number here. Next year is expected 8+%. I have no doubts in my mind about those numbers, just to be quite honest. Those could end up being low. As far as revenue growth goes, outside of a major recession, that could screw everybody up, right? Current year expected revenue growth, 4% for this year. I think that's probably going to end up being too low. And then 6% for next year, because remember, unit growth for North Italia and Flower Child is going to really pick up over this next couple years. So when I look at them, and obviously here I'm comparing them against Starbucks, comparing them versus CMG, do I see Cheesecake ever get into multiples that Chipotle trades at? No. I don't see this company getting to a forward P of 58 and a 2-year forward P of 45, and that's fine. I don't need it to go to that. If this stock goes to a forward P of 20, it's a win. It's a huge, monumental win, right? The upside for the stock is incredible. So that's where I look at something like this and I think about where's the real upside versus not so much upside, right? Chipotle is starting to get saturated. They're opening a lot of locations and that I'm looking at, or that are more and more questionable, that I think is going to come back to bite them. And then if I think about North Italia and Flower Child, their expansion opportunities next decade is just ridiculous. They won't even come close to reaching saturation in the 2020 through 2030 time frame, right? The Cheesecake Factory brand has reached saturation, in my opinion. You can't open that many more locations of that brand, but North Italian Flower Child, oh my gosh, we flipped my flapjack. So a lot of upside over the coming years for the cake. And don't be surprised if a lot of that upside comes sooner rather than later, especially if the Russell gets rolling. Now, let's speak about the moment I'm going to get more skeptical and bearish on this market, the exact moment, because a lot of people have jumped the gun over the last couple of years. We know that, right? Going too bearish too soon, selling out of their stocks, going short the market, buying puts. A lot of those Wall Streeters, you know my reaction channel, Jeremy Lefebvre Makes Money. We react to those Wall Streeters all the time. And what did you hear so much in 2022, so much in 2023, so much bearish talk? So much it's the end of the world, so much sell your stocks, so much only have cash, so much buy puts, short, blah, 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 right? And those guys all got it wrong. They got it very, very wrong, right? They jumped the gun. And they didn't understand enough about history. See, if you look at history, you're going to find something's very interesting. And it's that Fed cutting rates is actually not a good thing. It's not a good thing, okay? So, for instance, the last 3 times we went through a major cut cycle, basically in my certainly in my adult lifetime, I wasn't even an adult back here, I was still a kid, right? So basically, kind of almost in my entire lifetime, I was born in 1989, right? We've had 3 major cut cycles recently. One was, and when I say recently, it was really like 20 plus years ago, the first one, that was back coming out of the tech bubble after 2000. We had a major rate cut cycle. Then we had another major rate cut cycle into the great financial crisis. And then the last major rate cut cycle we had was going into Rona, right? Now, what's the commonality between all 3 of those cut cycles? Well, commonality between all 3 of those is all 3 of those corresponded with a major stock market crash also. The stock market hit very heavily in all 3 of those scenarios. All 3. And so when you look at that, if you just look at history, there's no way you can say by the Fed cutting rates, it's going to mean stocks are going to boom for the coming years. If anything, and remember, this was still a stock market crash, but it was a very quick stock market crash because then the Fed went from cutting rates to also just massive backstopping, we know, in regards to what happened in that Rona situation, right? So that one we got that kind of fast. These other 2 were much more vicious in terms of how long it took to kind of go down. This one they were able to get away with, pumping money, stimulus, all that, because it was a government forced shutdown. These 2 obviously were not. So it took a while for that to play out. And so when I think about when I'm going to get more bearish or concerned about the market, it's when it's going to be right after the Fed starts cutting rates. Because you might have a week or maybe a month or 2 of fun where people think, oh, the Fed's cutting rates, this is great, we beat inflation, market's going to go to the moon now. But very shortly after, you could start to run into a lot of troubles in regards to the economy, the employment market, and things like that, right? And so let's imagine there's a scenario where the market is risk on all through the summer, which usually the market's not super risk on during the summer, but let's imagine we get that scenario. And the market's just booming during the summertime, right? On rate cut hopes. Then let's say the cut actually happens at some point in Q4, the first cut happens at some point in Q4, 2024. That would be a moment right after that, I'll start getting a lot more hedges for 2025 because I'll get a lot more concerned about the market and for 2026 if that were to play out. So if you ever hear somebody say rate cuts mean stocks will boom, just understand they don't know history. They don't know history. It's a straight up lie. It's 100% a lie, right? If you are a market participant, honestly, you should be hoping that rate cuts don't happen until 2025 or 2026. That's what you should be hoping. Right there. That's what I hope. I hope we don't have to have rate cuts this year. I would love rate cuts. They push the rate cuts out as far as we possibly can. Because I'm just telling you, the likely probability is once the Fed starts cutting rates, you're going to see more and more potentially bad stuff actually happening in the underlying economy. And so I'm in no rush for that. If we can hold that off till 2025, if we can hold it off to 2026, great, right? And so we'll see if the Fed has enough excuses to use in between then. I think for right now, they got all the ammo they want. I mean, CPI is still in the 3s. You don't have to cut. Unemployment still in a low place, 4%. They don't have to cut. If unemployment goes above 4.5%, then you've got to cut. If CPI comes in several months in the 2s, the Fed will have to cut, right? And then that's when I start to get much more concerned about the market. But for right now, yeah, it's party yarn in the market. And so you got to understand this is the game that's being played. But just to understand, when the Fed actually starts cutting, if you think over the next year or two, stocks are booming, we're going to the moon, maybe that happens. But the last three times, it all ended very badly for the next, good chunk of time. So just a little food for thought in regards to that, guys, because I want to explain when I'll get a little more bearish on this market overall. So we got some time here, okay? All right, guys, appreciate you joining me as always. Thanks so much for being here. 1000xstocks.com. I showed that a little bit in this video here today. If you're looking for access to that so you can compare all these different stocks, look at all the different metrics, growth rates expected in the future, margins, all that stuff, try to figure out if these stocks are great deals, bad deals, things like that, as well as listen to conference calls right through the service, all that fun stuff. Then click the pinned comment here today, fill out an application to get access to 1000xstocks.com. Much love and have a great day.